Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending February 28th, 2020, the end of the week, the end of the month, and I'm sure it could not come soon enough for many people out there. So this is the Dow Jones Industrial Average, a one-day chart, and it lost 12.3% this week. So just to be clear, this is not a dip, this is a crash. For the Dow, this is the fastest decline from a record high since just before the Great Recession. And to put a face on that, that would be this decline. And notice too how we went into it. A big, strong rally. People couldn't imagine anything else other than stocks going up until that changed. And that led to this big, ugly bear market. So I'm not trying to infuse this video with hyperbole or anything like that. I'm just keeping it real. When you see a market do something like this fast, that's not a dip. That's not a pullback. They call it a correction because it's 10% off the high, but it's really a crash. I mean, just respected no technical levels whatsoever, no moving averages, the 50-day, the 200-day, no prior pivot lows where you might expect to find some support, just a crash. For the S&P 500, that was the fastest decline from a record high in its history, and that's about $4 trillion of market cap wiped out in a week. All of the Fed's repo and QE and all of the trade war optimism, phase one trade deal optimism, everything that occurred over 4 months. I mean, think about that. All of that wiped out in 1 week. So it's the stairs up, the elevator down. And unfortunately, there were signs that this was coming. There were signs that something bad was coming, that the equity market was mispricing risk. And quite frankly, just Wall Street got this wrong. Here's a quick clip from my video last week and what I was seeing and why I thought it was really urgent to get out. The bond market, the currency market, the commodity market, when we get to gold or when we get to TLT, you'll probably see what I'm talking about. And what they're all screaming, not warning, but screaming, is that this coronavirus is a big deal. It's not contained, and they're screaming that there's a lot more to go on the downside. And the problem is stocks discounted about 3% over here and then went on to rally to new highs. They're really disconnected from economic reality and from the macro picture that's been developing. So this decline was so fast, so ugly. I mean, look at the closes almost every day, closing at the low of the day and just continuing lower. The only day we didn't close at the low of the day was Friday, and we'll get to that in a moment. Last week, we just started breaking this trend, and let me show you this area a little bit closer on an intraday chart. And this is a 15-minute chart, by the way. So here's Monday, and right here, around 32.15 or so, once this broke, see, we had a little bit of support there Monday. Once this broke, it unleashed the dam of CTA sellers. They apparently had a trigger level right here, and once this broke, it was just all downhill from there. And why I say I've never seen a sell-off like this, when you're over 10 or 12%, generally speaking, we get some kind of a little correction like this about in the middle of it, and you can get a pretty good idea for how much further it's got to go from a measured move. We didn't get anything like that, just sold off the entire week, closing at the lows of the day. We did find some support on Friday, but as you can see over here, and we did close at the high of the day, but as you can see, that is a bearish flag consolidation on Friday. So price action remains bearish. Remember this broadening top, and this is right where the Fed started expanding their balance sheet. We're right back at that level. That's back in play. As a matter of fact, on Thursday, broke down right through it, and once a level of support, and you can see this was prior resistance and it became support. Once that level breaks, often it turns into resistance, and the intraday high on Thursday, and a little attempt to rally, found resistance right at this trend line. So the takeaway is that this broadening pattern is back in play, really only broken because of the Fed's balance sheet expansion over here from about September, October. So I did something this week that I don't usually do, and that is I turned up the volume on CNBC just to see what they were saying. And I was really struck by how many times early in the week they were saying, valuations are so much better here. This is a buying opportunity. And then prices would go down more. And then the guests started to change, and the guests started to be more like, oh, yeah, we saw this coming. Well, where were these people? Now, to be fair, this is a difficult thing. I haven't seen a sell-off like this. not in terms of how deep it is, but in terms of how fast it is, how aggressive it was. So this is a chart of the S&P 500 hourly and the 30-year yield. I haven't seen anything as perverse as the 30-year yield at an all-time record low while stocks were at an all-time record high. It was just stunning to me that that would happen, that stocks would be that oblivious of what the bond market was pricing in. And you can see, what the bond market was pricing in, it was way down here below these August lows early in this week. And stocks, were still just right off record highs. You might look at it this way. Yields showing that there was problems. When the market rallied up to a new high over here, what did yields do? They didn't rally to a new high. They just consolidated in a bearish price pattern and broke down again. As we came into the week, stocks had not discounted all of this, which was a lot. And then as we had come into the week, yields were already moving lower on a second leg decline. And it's pretty much an equal leg or measured move from this first one. So it's basically what it's saying is the bond market saw big problems ahead. It discounted even more of a negative impact to economic growth. So I think that's probably why the stock market didn't consolidate somewhere in the middle of this. It had a lot of catching down to do just from over here. Then we got even more. And it still has not caught down to what has really happened in yields, in commodity prices, in currencies. Let me show you a couple of other markets real quick. In gold, how gold's been acting. So this yellow line is USO for crude oil. And when you see a 20+% decline in crude oil, it's telling you that there is a economic shock ahead, that's what it's pricing in. So the fact that stocks pretty much ignored this, just a minor pullback, less than 3%, rallied to new highs, these assets were screaming that there was trouble. And now crude did bounce, but this was just a bearish consolidation and then broke down. So this is a second equal leg lower. So these asset classes, bond yields, crude oil, or the Australian dollar, big first leg, consolidation, second leg, these are all screaming. Actually, even gold. So here's GLD for gold. I'm just going to invert it real quick, and you'll see what I'm talking about. Same thing. So it was screaming. It actually started breaking out while stocks were at new highs. And this was, like I said, one of the reasons last week I've said it was so just obvious that something bad was coming. Here's a daily chart of VIX. And the first thing I want to point out is the relative strength here from August of 2018. This is very unusual. The last time this happened was actually right before the financial crisis in 2007. You won't see this happen any other time. VIX making this trend of relative strength higher while the market is making new highs. So this week, 135% move in volatility. Remember, we got that buy signal back here from the absolute breadth index. And even as the market made a new high, VIX did not even pull back to this trend line. So relative strength here, and there's the breakout. VXX gave us a nice positive divergence into the 12th and 13th of February. And this was followed by a big negative divergence in IWM, which you can see over here. And look at the date into the 13th, 14th, and then all the other averages followed with the same negative divergence, even though stocks kept trading higher. Here's the NASDAQ negatively diverging. You see around the same time here, around mid-February, into new highs over here. And this is actually when the FOMC minutes came out and the Fed said that they were going to be tapering repo and that conditions were right to taper QE. That is pretty much when stocks really started selling off, and we saw tech, and check out last week's video, we saw tech acting real bad, and tech is usually one of the last places to break down. Look at the signals this week. It's just confirming to the downside, so still very ugly on these 3C charts. And while stocks were moving higher, there were signs of weakness, like this is the NASDAQ 100 in red and green candlesticks, and this is the NASDAQ Composites Advanced Decline line. So you can see it did diverge into this high, and we got that correction over here. And then what was really bad was we see a new higher high over here, no new higher high over here. So that's a really ugly divergence, and this was the ugliest divergence in breadth since the sell-off in 2018. And to put it in another context, at this point where the NASDAQ is at an all-time record high, you had half of the NASDAQ stocks that were in what they would call a technical bear market, which means 20% off their highs. So what that means is when you do get a sell-off like this, and you've had a half dozen stocks basically that are heavily weighted, those FANGs, the mega cap tech stocks, when you have those stocks finally break down and you already have half of the rest of the index that's trading 20% below their highs, Nobody wants to buy those stocks. So when you do get a breakdown like this, it can be really intense like we saw this week because there's no other stocks there to support the broader market. So you could say this is a perfect storm of sorts, but the Fed was pumping all this liquidity into the market. Nobody wanted to hear it. Nobody cared. Nobody cared about valuations, even though earnings were, well, let's see, 480 S&P companies have reported earnings, and their growth rate is zero, actually 0.69%. Without utilities, it would have been negative growth. And let me say one other thing. I thought something real bad was coming. I didn't expect something this bad this quick. When you see a sell-off like this, something has really changed, and especially when you see volatility break out like that. And when something like this happens, indicators are they're useless. So when I use my indicators like 3C, what I'm trying to do is get an idea of what price might do next. But once price starts moving like this, price is king. The indicators at this point are pretty much useless. We did find some support on Friday, and over here you can see it on the S&P 500 from October 3rd, which is 28.55. 28.55 comes from this October 3rd low. It was literally 10 cents from that low. And then the Dow, and with the Dow, you can see the relative performance was weaker because it was making a much lower low. And that comes from June over here. That's when Fed basically first said we're going to be open to cutting rates, or Powell said it right here. Got this big rally. So that level is 24,680. And for IWM, August 28th low, so 144.25. And the NASDAQ 100 actually did hold its 200-day moving average. Bounced off that and closed near the high of the day. Remember I showed you the intraday chart of price action. Still very bearish, but this was the best price action that we saw all week. So with a sell-off like this, there was no consolidation. There's no way to get a measured move target. I'll talk about this a little bit more in a minute. So I went by other asset classes and what their measured moves were. So if we look at the bond market, TLT, this is a first leg up, consolidation through February as the averages rallied to new highs, and then a breakout again. And this breakout started before the sell-off in stocks started. So this was one of the signals that was screaming because stocks had not priced in this move yet. So my measured move target for TLT was 153.50 to 153.75, and it hit that easily here on Friday. Here's GLD for gold, and this had, again, one leg up, big consolidation, bullish consolidation, second leg up, and my measured move for this was 1,700 for gold. So gold fell less than 0.5% short of that target on Monday over here. So for all intents and purposes, gold hit that target. And interestingly, it sold off the rest of the week. We'll take a closer look at that real quick. So here's that high on Monday. And for whatever reason, it was really weird. Monday afternoon, sellers came in. So some people think this was the bank, the BIS, the Bank for International Settlements, which is like the central bank. Other people think it's the Bank of Japan selling gold to defend the yen. But the point is we got a measured move right here, consolidation. So we got that first leg. And this was the target for the second leg. So we hit that on Friday and actually closed right at it. This is the top of that bullish consolidation, and this was the bottom. So let me just back this chart out. But Friday, really heavy volume. I mean, they just dumped gold on Friday. So it's hit the measured move, and I think this is an interesting area to be aware of what's going on in gold, but price action has not firmed up yet. We have TLT that met that second leg measured move. We have gold that met its second leg measured move. And then we have crude oil. So, when crude breaks down 20% like this, it's sending a really negative signal for economic growth moving forward. Got a consolidation as stocks rallied in February to new highs. This is just a bearish consolidation, though. It did not change the bearish outlook. Second leg down, and the measured move target was 940 for USO, and it hit that Friday. We have TLT, we have gold, and we have crude oil all met these second leg measured moves. Now the stock market is just pricing in this first leg right now, and maybe a little bit of the second leg. But the point I'm trying to get at is, as far as measured moves, these are the best we have, and they are complete. That doesn't mean they can't go down further, but they are complete, and the averages did find some support on Friday. So heading into next week, we did find some support here. Keep in mind, a lot of this could be just shorts covering before the weekend. Did close at the high of the day over here, but this still is bearish price action. That's a bearish consolidation. So there's a little bit of good, but there's still a lot of uncertainty here. Like I said, be careful with indicators, but as far as I can tell, no improvement here at all. Lower lows in 3C with price. So this would be a reasonable place to expect some kind of correction, consolidation. Because volatility is so high, I can almost guarantee in the next week or so, you will see 1,000-point move in the Dow. Whether it's in a day or a couple days, you'll see 1,000-point big move up in the Dow. We had 4 days that it moved over 1,000 points intraday. If you see 1,000-point move, everybody's going to be saying, oh, happy times are here again. This is just a function of volatility and being deeply oversold. I mean, look at what this market did. That is 10 months of gains. 10 months of gains wiped out in a week. I'm just being honest with you from what I see. And because I didn't see any kind of consolidation between this, to me, this looks a lot like a first leg down. I think it's more like this first leg that we saw here in October. And then we got 4 or 5, 6 week consolidation over here before we dropped into a second leg. So that is my gut feeling. We'll have to see how the market goes. I think if you're an investor especially, you have to ask yourself at this point, where are we in the cycle? I look at this 10-year yield, and this is a long-term channel. You can see the years down here. And generally speaking, when it peaks at the top of this channel and rolls over, that's kind of the end of the cycle, the end of the business cycle. When it hits the bottom of this channel and moves up, that's the beginning of a new cycle. So yields peak over here in 2000. What else peaks? The stock market. In 2006 and 2007, what else peaks? The stock market rolls over. Down here we have a low at 2009, got a new cycle starting. In my opinion, I think we peaked in the third quarter of 2018, which happened to be right here going into the sell-off. So that doesn't mean the stock market peaked, but I think the economic cycle peaked and rolled over, and we're very, very late cycle. I think the only reason we blew through this broadening formation, this broadening top, was because the Fed just pumped $400 billion of liquidity into the financial system in 4 months. So keep an eye on the news this weekend, what the central banks do. This is a first leg. What usually happens is credit markets start to implode. When credit markets start to implode, sell-offs get real nasty. That's when you know the Fed will intervene like they did over here. Because at this point, when credit markets were just basically frozen for 40 days, GM couldn't roll over their bonds. And I think that's really what motivated the Fed to do this U-turn. I don't think it was so much a sell-off, but credit markets. So pay attention to like high-yield credit. It actually ended the week pretty well. Pay attention to investment grade. This is probably going to be one of the last to break down if credit really does get ugly. So investment grade is holding up there with yields low. It loves that kind of stuff. And the one that I'm worried about is leveraged loans. And I'll show you why. In September, they got real ugly, real fast. This is actually when the Fed started repo and then started QE right after that. So leveraged loans, they've been ugly here. They've been real ugly. And the other thing to think about going into next week is pension fund rebalancing. We'll leave it at that for now, and we'll see how things go next week. If you like the video, please give it a thumbs up. If you have questions or comments, leave them in the question comment section. If you like the videos and you think they're valuable, share them with people, because what I've noticed is ever since I started talking about coronavirus, it's kind of almost like I've been censored. Here's that coronavirus video I did. Almost like I've been censored since then. And this last video, it had like a third of the views that I would expect, and the ratings were great on it. Just nobody saw it. It's like the algorithm here has put me on the back shelf. And I think that really sucks, because I'm out here and I'm doing this to help people. If you guys enjoyed them, please go ahead and share them with people you know might enjoy them or might get some benefit. Because I'll tell you what, if you didn't make money this week, hopefully you didn't lose money this week. You didn't lose this kind of money. And if you really like what we do, slide by the website and check out subscribing. It's really not a lot of money for getting 10 some odd posts a day telling you exactly what's going on, what I see. So on that note, everybody have a fantastic weekend.